So we've experienced quoted inflation. In the UK, it's up to about 10, 11%. I think the US reached close to 10%,
I
didn't
think
it?
it got into double digits
Did
for
it
a
go
while.
double digits? We all know realistically it's been higher. Certain things have been, I mean, energy in the UK has been, well, I mean, up to 100, 200% energy price inflation. You know, we've seen people have their energy prices double or triple. So we've seen we've seen high inflation here. We've seen it in the US. We know it is much higher. So is it what you're saying is that this kind of like 10 to 20% could continue for a few years, but there's a chance they might squeeze in some high double digit, potentially triple digit. And what you're saying, could that happen in the next 2, 3 years, or do you think it's a bit further down the line?
I think my base case is that they are going to try to keep it in the double digit range without letting it get away from them.
Right.
But I think that is an increasing risk. I think it's going to be over the next 2, 3 years, really. And we may get this sort of deflationary whoosh in the very short term. I think you're seeing symptoms of it, from a credit and lending standpoint. But if you read the history books on a lot of the great inflations, they almost all, there's a quote, I wish I know who said it to me. It's not one of these famous ones that you can sort of Google and find who said it, but I've had it said to me a couple different times, but it's deflation is the midwife of hyperinflation. And that's not to say I think we're going to hyperinflate, but these great inflations are ultimately driven by sovereign insolvency, and deflation and sovereign insolvency are fundamentally incompatible. And so they want to get inflation down, but they're not going to be able to get it down enough. If they get it down too far, then they can't pay their interest, their entitlements, and their defense bill out of tax receipts. And then given the choice between defaulting on target treasuries in the case of the U.S., slashing defense spending in the U.S., or slashing entitlements in the U.S., which right now are already at, the three of them are like 110% of receipts and rising, then they have to print the difference. And they can try to crowd out the banking system, right? They can regulate the banks into buying treasuries, which they did, and until that blows up, oops, that's already blown up. They can regulate the domestic sector into doing it, but here too, that simply increases the deflation because I can buy a car or I can buy a treasury bond portfolio. I can't buy both. And so if I buy those from the government, I start detracting from consumption. I detract from consumption. I detract from tax receipts. That means the amount the government needs to either borrow from me or print over rises, not falls. And so they're into this loop. And in this conversation of inflation, deflation, deflation's been the only thing, or excuse me, inflation's been the only thing keeping receipts high enough so that they don't have to print. And now with inflation coming down, you can see it in the numbers and the receipts. The receipts are falling below these things, these uncuttable things. And that's why I say deflation is the midwife of, I won't say hyperinflation, but of high rates of inflation. Is now they face a choice. You want to call up Zelensky and say, hey, sorry, our tax receipts stink. We're pulling out. Have fun with the Russians. And oh, by the way, Taiwan, we're going to pull back there too because we can't afford it. Or is the Fed going to print the money? The Fed's going to print the money, ultimately. Right now, we're in this sort of, stage of, hey, the American people and the American banks, well, we're starting to realize the American banks aren't going to finance the government anymore. That was sort of 2013 to about 2 months ago. That suddenly, the folly of that is suddenly beginning to be realized that was not a permanent solution. So now it is American people or the Fed financing U.S. deficits. So this deflationary impulse just accelerates this whole game.
So do you think they're going to end the hikes, and do you think we're going back into QE then?
Yes. I think ultimately the U.S. fiscal situation is going to force them to end hikes first. And in some way, shape, or form, you can already see, the BTFP program, that is essentially a yield curve control light for banks, right? So the banks had these treasuries. They were trading at 70, 80 cents on the dollar. And the Fed came in and said, no, that's not the price. The price is par, and we'll lend you the money at 5%, and we'll value that collateral at par. That is essentially, bringing down the effective yield on those bonds. That's a yield curve control soft for the banks. U.S. Treasury has quietly been spending a lot of time looking at a Treasury buyback program. And so it was really interesting. I pay very close attention to every quarterly release of the Treasury Borrowing Advisory Committee report. So there's a TBAC, Treasury Borrowing Advisory Committee report. A group of market participants meets quarterly, and they make recommendations about all kinds of things to Treasury, issuance, how to the tenor, long dated, short dated, expenditures, what the market's thinking, et cetera. It's a very useful document. It gives you tax receipts. It gives you what they're spending it on, et cetera, how auctions have gone. And so the calendar 1Q TBAC report, kind of standard thing, and there was nothing at the back of it. Recently, there was an update someone pointed out to me. I didn't see it on January 31st because it wasn't there. They amended it after the fact. There's a 38-page addendum that they amended after the fact to the 1Q TBAC, looking at, what do they call it? It was a clear and regular Treasury buyback program benefits or something like that, right? So it was, and it basically here too is, we're not doing this to fund the Treasury. We're doing this to maintain high-functioning Treasury markets. And what we'll do is we'll issue new treasuries that are more liquid, and we'll buy back off the run treasuries a little more illiquid, and that'll bring the yield down a little bit. And that's the dog whistle. I mean, it's they can say whatever they want to say. It's a soft form of yield curve control. It is a soft form of QE. It's a soft, because basically there's plenty of demand for the very front end stuff because that stuff's being used as collateral by the markets, which, as you add leverage to markets, there's more demand for collateral, et cetera, et cetera. So they've got no problem with that. Where they have a problem is sort of everything beyond 7 years, which is where they should have been terming it out a couple years ago, but that's because they probably couldn't. There wasn't the demand in the size they needed. My point in highlighting this, the BTFP and the Treasury buyback is, I think they're moving towards, they know they have a problem. They're not spending 38 pages and sticking it in after the fact for shits and giggles, right? This is not some academic exercise. These are not academics. These are people at BlackRock and Goldman and these are market participants. And so they know they have a financing problem. This is a balance of payments problem in the United States and the reserve currency issue of the world. And they're trying to address this while not going straight to QE, right? It's the old, what I've called trying to ride two horses with one ass, which is they want to maintain their credibility as inflation fighters, but they also need to finance the government. And those two things with debt and deficit levels here are fundamentally incompatible. The only thing keeping the government financed is the inflation they claim they need to fight. So I do think they will stop raising rates. Maybe they do one more and then they stop regardless of where inflation is. And then I don't know that they go straight to QE, but I do think we will get increasing liquidity injections in the manner we've seen, which is it's not QE, it's BTFP. It's not QE, they are regular Treasury buybacks that are smooth the functioning of the Treasury market or something like that. They're liquidity injections, right? It's I'm reminded of the movie The Fugitive, right, where he's Harrison Ford says, "I didn't kill my wife," and Tommy Lee Jones says, "I don't care." To me, I see all these economists saying this isn't QE. And I say, I don't care. It's inflationary. They're injecting liquidity, trying to preserve the functioning of the Treasury market.
So just thinking back to what happened with Israel, because we often think of high inflation as being catastrophic to people living there. I mean, I've spoken to people who live in Lebanon. I've been to Venezuela. I've seen the impact on people. It's catastrophic. But as you said, with Israel, it's a great country to visit. It's got a successful economy. It seems a fairly wealthy nation. Is there a way of running high inflation, but consumer prices and wages are able to keep up with inflation, and therefore, most people, outside of people who hold large savings, most people are able to kind of ride through it, and it really is just the bondholders that get screwed, or did anyone else get screwed in Israel? Because it doesn't seem to have been a catastrophic for Israel, as I've heard it is in other countries. Say, for example, Argentina, their inflation levels have been catastrophic to people.
It was sort of the denouement, and again, I'm not as well versed in it as I should be. There was a long period of time leading up to this compressed period of very high rates of inflation, where very consistently you had deficit spending, you had unions with a lot of power, public unions with a lot of power, so you had sort of this inflation wage spiral dynamic. And I think this was finally just sort of the ultimate denouement to that sort of span of 20 years. Not that different than what we went through in the U.S., right? Just less extreme, right? Where we sort of went through 60s, 70s, and then there was sort of the spasm of last little inflation, and finally Volcker's like, enough, right? I'm taking it to 15%, and we're going to stomp it out. And that's what they did there, too. In terms of the social impacts, I would have to say it would probably be much more akin to the Argentinian and Venezuelan experience in America and in a lot of Europe than in Israel, where I think there's a number of Israel's a smaller economy. It is more what's the word I'm looking for? It's more monocultural than the United States or than the UK or than Western Europe. I think there is a greater sense of togetherness in everyone has to serve in the military in Israel, right? So there is a sense of togetherness and commitment to in a smaller country that is more sort of monocultural than I think we would see in Western Europe and in the U.S. So I'm not sure we could do it without some fallout politically, from a domestic standpoint. Like you get the sense happened there.
Yeah, so it's a really interesting time, because what it is based on the things you're saying, I'm able to start connecting some dots here. Anecdotally, I just bought a bar, right? And I've gone in and given all the staff a 20% pay rise. I think they're underpaid, and I'm able to do that. And I'm also able then to raise the price of the drinks, which pays for it, and also raise the price of the drinks to cover our new energy costs. So we are able to swallow our increase in prices, and we're also able to cover that by raising our prices. And it all just kind of works out. But I also know that it becomes a lot more difficult, say, for the government when they're getting wage demands from certain unions. So we're seeing a lot of strikes now from the ambulance workers. We're seeing it with UK doctors. We're seeing it with people who work on the trains. And these are brutal negotiations with massive strikes, so the kind of strikes we've not seen before. UK junior doctors at the moment have demanded a 30% increase in their wages. That's a massive increase. But in fairness to them, they've probably experienced close to that level of inflation over the last 2 years. And I don't know where their increase will come out. I think the nurses just got, was it about 11% and got some backdated pay? But we're starting to see massive pay rises from people who work within the government sector. We're also seeing a massive increase in prices. So that was why I was kind of asking the question, because we're starting to see that. Now, it will never be an even pattern, Luke, through everything. Certain companies can raise their prices, certain companies can't. Certain people can have an increase in their pay. But I wonder how it nets out. My suspicion is that it will all eventually net out, but those who hold assets will benefit more, and we will see an increase in the wealth divide, and that will put a lot of pressure on families, but that will also put a lot of pressure on the government to support those at the lower end, which probably means more printing.
and there's two things I would say. So here, most of our mortgages are fixed rate, right? So it's an interesting dynamic of a debt jubilee, right? So if doctors go up 15% here, costs, get a 15% wage hike, their mortgage doesn't move, right? So they're still paying 3% mortgages. So they've literally just gotten a huge debt jubilee on their biggest expense throughout most of this country. And they're 30-year fixed in America. Most mortgages are 30-year fixed. And my understanding is that's not the case in the UK, where there's 5-year fixed and then things can reset.
Even lower,
I think
Luke,
it's like
I'm on a 2-year fixed.
on a 2-year. Yeah. So that makes it trickier. And that ties into the second point, which is we frequently hear this case, well, America can't have an inflation spiral or a period of really high inflation because it owes its debt in its own currency, and it can always print that. And for the debt portion, that's absolutely true. But Social Security, we're paying a 10% cost of living adjustment. I want to say it's 9.7% for 2022. That has a cost of living side to it, right? But even then, we can understate that. The Medicare, Medicaid side of the U.S. entitlements, those are not owed in dollars. Those are owed in healthcare goods and services. That is no different than a foreign currency, effectively, right? So, you don't owe, the U.S. government does not owe, so between Social Security, Medicare, and all entitlements, Social Security, Medicare, Medicaid, some of the other stuff, this year will be $3 trillion, or about 65% of tax receipts.
Wow.
So, yeah, huge number. And the healthcare side of it is not owed in dollars. It's owed in doctor's time. And to your point, you start getting doctor's time, the dollar's collapsing against doctor's time. The dollar's falling sharply against hips and knees and, medical centers, et cetera, in the West. And so that's where you can, when I say whatever this 100% odds were, this odds of really high inflation for a compressed period of time, whatever they were 2 years ago, they've gone up. There was a very far out tail risk. That tail risk is getting fatter because you can see clearly how this could happen, right? Where you get another 8% cost of living increase. Boom. And oh, by the way, the government's interest expense is going up because the Fed, paradoxically, by raising rates, there's no functional difference between the U.S. government printing up $500 billion in stimulus and handing it out to the people, and the Fed raising the U.S. government's interest expense by $500 billion and paying that out. The only difference is who it goes to. The $500 billion goes to everybody, and the $500 billion stimmy goes to everybody. The $500 billion interest goes to the wealthy. And so it's very non-progressive, right? It's very very wealth increases the wealth divide. So, but you can see how this can happen. It is very much, and I say this with a big asterisk because this is not my base case, but it's, people say, well, yeah, the Weimar Republic in Germany hyperinflated because they had these war reparations, and the war reparations were not in Reichsmarks. They were tied to gold, and so the more Reichsmarks they printed, the more the Reichsmark fell against gold, the more they went up, and wash, rinse, repeat until it became obvious they could never pay it, and then we're in sort of that same position where we don't owe dollars, we owe healthcare goods and services. And the more inflation goes up to address the debt, the part that we will print because we want to avoid defaulting on it, that leads to higher inflation, but that then leads to higher cost of living adjustments in these things that are not denominated in dollars. They're either cost of living adjusted or they're denominated in healthcare goods and services. And that gets into this very, for lack of a better word, dangerous dynamic, because in this case, the doctors have a lot of leverage. Doctors just say, fine, screw it. I'll go work at Peter's Bar. I'll make, you hear in the U.S. after the last 30 years, what's happened to healthcare. We've got, plumbers making $350,000. And I have a friend of mine who's, a oncologist and hematologist with 25 years of experience, and he's probably not making that much money. And that's not to say I devalue plumbers relative to oncologists and hematologists. All I'm saying is that there's a lot of runway. There's been a misallocation of capital for so long into different trades, labor markets, etc., across the government spending, now you're sort of stuck. You need to reallocate stuff, and there's no easy answers.